Everyone is absolutely terrified of a market crash. They see their portfolios bleeding red, and what do? They slam the panic button. But what if that exact moment, that point of maximum fear, is actually a once-in-a-generation opportunity to build wealth? What if I told you recessions don't actually destroy wealth, they just transfer it to people who are prepared? For those with the right playbook, a downturn isn't a crisis, it's a fire sale. And today, we're breaking down that exact playbook. Okay, so let's just dive right into this. That quote is from Mark Tilbury, an investor who's been navigating these exact storms for over 35 years. And look, this isn't just luck, it's a repeatable system. For guys like him, recessions aren't a threat to their wealth. No, they are the very engine that creates it. They don't just survive the chaos, they use it to leapfrog everyone else. So that really puts the ball in your court, doesn't it? The next downturn isn't a matter of if, it's a matter of when. And when it shows up, there are going to be two groups of people: those who get completely wiped out and those who build absolute fortunes. This whole explainer is your guide to making sure you're in that second group. And you got to understand, the clock is always ticking. If you look back, the US economy hits a recession on average about every 5 years. That means these incredible chances to buy amazing assets at a huge discount are a regular, almost predictable part of the cycle. The next one is always just around the corner. So let's get you ready. All right, first things first, you can't win the game if you don't even know the rules. Not every single dip is a full-blown catastrophe, right? And knowing the difference between them, well, that's the critical first step. It's what separates a prepared investor from the panicked herd. Now, what's really fascinating when you look at this is just how normal these events are. A correction, a 10% drop, that happens roughly every 14 months. A bear market, a 20% drop, that rolls around about every 5 years. And a full-on collapse, super uncommon. The point is, market dips are a feature, not a bug. If you are not mentally prepared to watch your portfolio go down, you simply shouldn't be in the market, period. So if these downturns are pretty much inevitable, how in the world do you see them coming before it's too late? Well, the key is to recognize what Mark Tilbury calls the euphoria phase. This is that tippy top of the market, where just irrational excitement and this feeling that the good times will never end, that becomes the biggest red flag of all. And this slide just illustrates that disconnect perfectly. During this euphoria phase, everybody feels like a financial genius. I mean, think back to the 2008 housing boom, right? You could get a mortgage if you could fog a mirror. Or what about the recent NFT craze, where people were paying millions for digital receipts? These are classic textbook signs of way too much cheap money sloshing around. When it feels like you can't possibly lose, that's your signal the bubble's getting ready to pop. Spotting the signs is one thing, but actually acting on them, that's everything. So now we get to the real game plan. This is your pre-crash checklist. These are the concrete steps you need to take while everyone else is still partying to make sure you're ready for whatever comes next. Okay, let's get tactical. Here's your 4-step battle plan. Number 1, evaluate your risk and be brutally honest with yourself. Can you watch your net worth get cut in half on paper and not sell? If the answer is no, you're way too exposed. 2, kill your leverage. Margin loans are like rocket fuel on the way up, but they are an anchor on the way down, forcing you to sell at the absolute worst time. 3, stack cash. And this is not just your emergency fund. This is your war chest. It's the dry powder you're going to use to buy when there's blood in the streets. And 4, diversify. You never want all your eggs in one basket because you just don't know which one's going to get crushed. Now, during the crash itself, your biggest enemy isn't the falling market. It's your own brain. Everybody claims they're a long-term investor when stocks only go up, right? The real test is when they're in a free fall. The legendary investor Peter Lynch, he tells this great story about buying a stock called Kaiser Industries that just kept dropping and dropping, but he held on. Why? Because he understood the company had zero debt and massive underlying assets. It eventually rocketed to $50. You can only hold firm if you truly get what you own and why you own it. And hey, if you need any more convincing, just look at this number. Fidelity did this study and they figured out that if you invested 10 grand in the S&P 500 back in 1980 and just held on through every single crash and crisis all the way to 2022, you'd have over $1 million. The price you pay for trying to be a genius and time the market is almost always your own profits. So if you can't time the market, what's the move? This is it. Dollar cost averaging. You just accept that you are never, ever going to buy at the absolute bottom. Instead, you commit to investing a set amount of money consistently. When prices are low, your money automatically buys you more shares. This simple strategy turns a downturn from a source of terror into your single greatest advantage. Okay, so that's the stock market playbook. It's powerful stuff, but it's only half the story. What happens when all that chaos hits the housing market? Well, the core principles, preparation, courage, they're the same, but the signals and the strategies are completely different. So let's pivot to the real estate playbook and find those opportunities that are hiding in plain sight. So what are the hard numbers you need to be watching? Well, real estate expert Jay Scott lays them out. You're looking for 2 straight quarters of falling GDP. That's the official definition of a recession. You're watching for housing inventory to climb over a 6-month supply, because that flips all the power to the buyers. A big spike in mortgage delinquencies, that's a huge red flag, signaling that foreclosures are on the way. This isn't about feelings. This is the data screaming that the market is turning. So how do you actually adopt your strategy on the ground? Well, if you're a house flipper, you gotta play defense. You hunt for properties in A-plus school districts, because those neighborhoods always hold their value the best. If you're a buy and hold investor, you follow the demand. When people lose their jobs, A-class runners move to B-class, and B-class runners get forced into C-class. That means C-class properties can actually see demand go up in a downturn. And for commercial, you target businesses that are recession-proof, like self-storage and medical offices. People always need a place for their stuff, and they always get sick. Now, this quote right here, this gets at the single biggest and most counterintuitive mistake real estate investors make during a downturn. Let me ask you this. What's riskier, buying a property with a low down payment or putting a full 20% down? The answer might really surprise you. The crucial point is this. In a real estate recession, liquidity is way more important than equity. Having 20 grand in the bank to cover your mortgage payments and any surprise repairs is infinitely safer than having that same 20 grand trapped as equity inside a house you can't sell. The name of the game is longevity. You just need to survive long enough to hold that property through the storm. And cash reserves are what let you do that. And let me tell you, a huge part of survival is knowing your debt inside and out. There could be a ticking time bomb hiding in your loan documents that could blow up your entire portfolio. You have to know if your interest rate is fixed or if it can suddenly adjust and shoot sky high. And you absolutely must look out for a balloon payment. That's a clause that requires you to pay off the entire loan on a specific date. If that date lands in the middle of a crash when no one is lending, it's game over. And finally, after all the panic and all the pain, comes the recovery. This is what we call the Phoenix phase, where the market inevitably, and I mean inevitably, rises from the ashes. This is where all those smart, patient moves you made during the crisis pay off in a spectacular way. This timeline really tells the entire story, doesn't it? The crash creates the opportunity. The prepared investors seize that opportunity, buying great assets from people who are forced to sell. And then, as it always does, the market recovers, roaring to a new high and rewarding those who had the courage and the capital to act when everyone else was paralyzed by fear. So the core lesson, the single most important thing to take away from decades of market history is this. A bull market almost always follows a bear market. It's not a question of if, but when. The seeds of your greatest fortune are sown in times of crisis and maximum uncertainty. Your job isn't to predict the storm, it's to build a mark. And that brings us to the final, critical question. The end of one cycle is always the beginning of the next one. The warning signs we've talked about today, they're going to appear again. The opportunities will be there for the taking. The only thing left to ask is, will you be ready? This is the Brick by Brick channel, where we help beginners build wealth through real estate, one brick at a time. If you got value from this, hit the like and subscribe for weekly investor breakdowns.